You've been arguing for a long time that the pandemic has deepened the divide between rich and poor, and the divide gets worse as some of the rich put their vaccines in place and their stimulus in place and move ahead, and the poor, heavily in debt, just get further behind. So is this potential extension by the G20 of suspending the poor nations' debt payments, is it going to be enough?
I think the resounding answer is no. I think it helps. It helps in that it is still funneling through the end of this year, not yet decided, but most probably, funneling the capacity to shift from paying debt service to the dire emergency needs. So that certainly helps. But is it enough to restore debt sustainability in a number of cases, or more importantly, widespread to be the kind of catalyst to growth? No, absolutely not.
Well, what kind of step do you envision being taken? Is it something that has to come from, the richer nations to the poorer nations? We know that in what we've seen with this new cohort of countries that entities that lend to these poor nations, including China. It's not just the Paris Club and a handful of governments, that it's much harder to get these deals done. And one of the big criticisms is that they often help the private creditors more than they help the poor nations.
And it's a good criticism, right? I mean, take the DSSI, which you had mentioned. We have had no private sector participation to date. So, the issue of free riding on the official sector is not a new one, Kathleen. That is one of the takeaways from the developing country crisis of the 1980s. Notwithstanding that, I think we're going to be moving to the next stage, which is, if you take the poorest countries that are, the 74 countries that are eligible for DSSI, about half of them, little more than half of them, are either in debt distress or approaching it. Though that's going to require debt forgiveness. It's going to require haircuts on the part of creditors. Mm-hmm. And there is actually no substitute for that. I think it is the realization that these countries' capacities to repay is not what it was when those loans were made.
So, Carmen,
or when those bonds were bought.
Another big concern right now that seems to be heating up is that vaccines, stimulus, U.S. economy picks up, investors bet on maybe some inflation, maybe a Fed that moves quicker to start removing stimulus, at the very least tapering their bond purchases. Are you worried that this could trigger the kind of damaging sudden outflows of money from emerging markets as the IMF is?
Most certainly. Look, I hate to say how long ago, more than 20 years ago, I wrote a piece with Leonardo Lederman and my mentor, Guillermo Calvo from Columbia University, precisely on the issue of the very central importance of U.S. rates and how they drive capital flows. The most recent IIF report already shows that capital flows have weakened again and are at their weakest point since the major shakeout that we saw last spring.
So, you have warned, in fact, that emerging markets may have to deal with the need to raise rates to shore up their currencies, to prevent capital flows and limit the upside on inflation. But you point out that, look, these countries have already been hit so hard by that pandemic, right? So the last thing they need is higher rates. What would this do to countries like the Philippines, like Indonesia?
So look, higher rates are a very tough choice. But don't forget also, Kathleen, that countries have fought long and hard. Emerging markets also have fought long and hard to have a credible low inflation environment. And low inflation is very regressive in emerging market. It hits the poor very hard. It hits food prices, which make up a big chunk of the basket of lower income households. So it's a very tough environment because you don't want to raise rates in the midst of what is still a downturn. And at the same time, you can't sit back and say, okay, we're not going to worry about inflation. Because that also in itself is quite a regressive setback.
Did you worry about policy credibility, central bank independence among the emerging markets as they try to navigate these very tricky waters, right? And do they run the economy hot and like they kind of echo the Fed? It's a temporary burst of inflation, and is that potentially undermining them in the long run?
The idea that emerging markets have this full independence of monetary policy is just not there. It's just not there in reality. Big economies, what the US does, what the ECB as a whole does, is not something that is in the capacity of even big emerging markets. Witness Brazil, which raised its rates in the midst of what is a horrendous health situation and a deep recession. That's never been the case. Now, on your question on central bank independence, I think that's a question for everybody, not just emerging markets. We are heading into a post-COVID world in which raising interest rates will be not without significant costs in terms of what it implies for debt servicing. Now, let me just get back to the emerging market question. Rates may rise because central banks tighten, or they may rise because they don't, and inflation expectations rise. So, as I said, it's kind of a tightrope act that we're in, which is a very difficult situation, which is why you hear so much worry around the annual meetings. Or the fact that we have a very uneven recovery with, of course, the U.S. And to a lesser degree at the moment, Europe doing much, much better than not just the poor countries, but the middle income emerging market class as well.
Well, what's the answer here? What do you do?
Look, I think countries have to continue with social policies as long as the pandemic is creating ravages. We're seeing new spikes in India. We're seeing spikes in Eastern Europe, all over South America. There are concerns. So we're still in the midst of an emergency. I think, however, the idea of, I think it's very dangerous to say, okay, let's go back to 20 years ago and give up on all the gains that have been made, on establishing the credibility of central banks and maintaining a stable environment, which is, as I said, very important for the households that don't have the ability to hedge against high inflation.
You mentioned debt servicing, and you also just now, and last week you wrote another piece where you talk about a quiet crisis in the financial sector gathering momentum. And I think when we put this in the context of borrowing, pandemic-related borrowing, it's pushed up total outstanding debt in the developing world to 250% of these countries' combined GDP, government and private debt up $24 trillion. In China and South Korea, two pretty strong economies, are among the biggest borrowers. How does that constrain what countries can do, and what does it mean in terms of this quiet financial crisis?
So, look, I think, Kathleen, as we've been discussing, there's a lot of focus on what fiscal policy is doing, a lot of focus on what monetary policy is doing. But where does the quieter financial crisis come from? Well, one thing that doesn't get talked about as much is that from the wealthiest economies to the poorest, there has been some considerable amount of temporary moratoria and grace periods, giving households and small and medium businesses especially the ability to withstand the lockdowns. At some point, those moratoria, those programs end. At some point, I think more will be revealed of just how much of the existing debts are non-performing loans, or how much of the small and medium businesses that have been kept afloat will have to shutter their doors for good in terms of bankruptcies. That is, I don't think, without any melodrama, I think that is a real risk, because the longer it takes for us to overcome this pandemic, the more the balance sheet damage that is being done by this on and off need to shut down, to curtail travel and any kind of normal activity.
So I want to ask you about the question of special drawing rights. The U.S. Treasury Department, Janet Yellen on board, notified Congress of the support for the plan the IMF has to let the poorer countries, let everybody use their special drawing rights, which you can exchange for dollars to pay down debt or buy imports, et cetera. That this is something that will help poorer nations. Do you agree that it will do that much to help them? And some people say, yeah, but it'll help the richer nations even more.
I think, in these things, the devil is in the details. And I think as allocations get shifted more to those that need it the most, I think it will help the poorer nations. I think the IMF needed the additional firepower. Remember, in 2008, 2009, we had these super mega programs with Greece, with Ireland, Portugal, Iceland. Those were record-shattering programs. The IMF got an injection of SDRs at the time, and it was needed then, and it is, I would say, even much more universally needed now. So I think that again, the allocation will, in the end, be favoring also those countries that need it the most. But it's still, Kathleen, not a substitute for debt write-offs. I think creditors, private creditors, official creditors, whether it's China, UK, France, Saudi Arabia, whoever, will have to come to term, along with the bondholders and all the commercial lenders, that debt restructuring, serious debt restructuring, will be needed for these countries to be able to restore some element of the setbacks that have already been suffered. Poverty rates have spiked for the first time in more than 20 years.
Is this a threat? I've asked you this before. At this point in time, is this a threat that could spread from the poorer nations, spread from the emerging markets as maybe rates do start rising, or at the very least stimulus starts tapering in the U.S. and other places, as the dollar continues to strengthen? Is this something that becomes more of a systemic problem for financial markets?
Look, contagion, the financial contagion, which is something among emerging markets that we really haven't seen since the 1990s. Remember, we had the Mexican tequila crisis, we had the Asian crisis, we had the Russian crisis, which was rolled into LTCM. And that brings me importantly, so Kathleen, I do think the contagious element is something to be concerned about in this environment. I would also note that, the Archegos accidents of this world are also, we are living in a very expansive global liquidity environment. There's a lot of risk taking that low interest rates bring about. So, I concluded with the interaction between the Russian default and the LTCM crisis, which was not entirely related, but they were they shared a lot of common ground, and I think that kind of risk take on the part of financial firms, coupled with what is already, as I noted, for many reasons, a fragile, more fragile emerging market. Although there is huge differentiation across emerging markets, we can't lump them all into one bag. I think does set the stage for the possibility of some nasty episodes, especially if there are, surprise interest rate spikes in the U.S. for any reason,